Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah.
And I'm Mike. This week, we're covering the period from March 15th through March 22nd, 2026, and we saw some significant movements across aviation stocks with a clear divergence between winners and losers.
Absolutely, Mike. We had Delta Airlines leading the charge with a nearly 7% gain, while Boeing took a substantial hit, dropping over 7%. We also saw a cluster of filings this week that gives us some insight into where these companies stand operationally.
Right. And what's particularly interesting is how the market seemed to reward operational excellence while punishing execution risk. We had 10 SEC filings across our coverage universe, including quarterly reports from FedEx, and several 8K filings that suggest some material developments across the airline sector.
Let's dive into the numbers and see what story the market is telling us this week. We'll start with our market overview, then dig deep into Delta's impressive performance, analyze those key filings, and of course, address the elephant in the room with Boeing's continued struggles.
Sounds good, Sarah. Let's get started.
Mike, when I look at this week's performance across our coverage universe, I'm seeing a really mixed picture. We had Delta Airlines closing at $63.44, up 6.86%, which was clearly our top performer. On the flip side, Boeing at $195.12 was down 7.42%, making it our biggest loser. United Airlines showed some strength at $89.95, up 2.02%. But then we had Alaska Air Group struggling at $36.91, down 3.83%.
That's exactly right. And if we look at Frontier Airlines, they really got hammered this week, down 6.47% to just $3.18. What matters is that we're seeing a clear separation between carriers that investors view as having strong operational fundamentals versus those facing structural or execution challenges.
The cargo side showed some resilience too. FedEx gained 1% to $358.85, while UPS declined 2.16% to $95.86. Even in the leasing space, we saw some pressure with AerCap down 2.27% to $131.60.
And Sarah, when I look at the regional and ultra-low-cost carrier space, there's a concerning trend. Frontier's 6.47% decline, JetBlue down 3.12%. These aren't just market jitters. These are stocks trading at extremely low absolute levels. JetBlue at $4.03, Frontier at $3.18, which suggests the market has serious concerns about their ability to generate sustainable returns in the current environment.
That's a great point. The more important signal is how the market is rewarding scale and operational efficiency. Delta's surge, United's modest gain, even Sun Country's 1.59% uptick to $15.95. These suggest investors are gravitating toward carriers with proven track records of managing through volatile periods.
Exactly. And in the manufacturing and aerospace side, we're seeing similar dynamics. General Electric dropped 5.59% to $286.79. Textron fell 3.46% to $88.77. And Raytheon Technologies declined 3.20%. This suggests broader concerns about the aerospace supply chain and execution risk across the manufacturing base.
Now, Mike, looking at this week's patterns, what would you say is our narrative of the week?
This week's narrative was operational credibility driving valuation divergence, with investors rewarding proven execution while punishing companies facing delivery or structural challenges. Operationally, this means carriers and manufacturers with strong operational metrics and consistent delivery capabilities are gaining market share confidence. For investors, it signals a shift toward quality and execution track records over growth at any cost strategies in the current aviation cycle.
That makes a lot of sense, especially when we consider the filing activity we saw. Speaking of which, let's dive deep into our top performer this week. Delta Airlines, with that 6.86% gain, really stood out. Mike, what's driving this confidence in Delta?
Sarah, Delta's performance this week really exemplifies what institutional investors want to see in the current environment. While we don't have specific quarterly results from them this week, Delta filed an 8K on March 17th, which typically indicates some material development or update to their business.
Right, and when I think about Delta's positioning, they've consistently demonstrated an ability to maintain pricing power and operational reliability even in challenging periods. Their hub structure, particularly in Atlanta, gives them significant competitive advantages that some of their peers simply can't replicate.
Absolutely. And Delta's fleet strategy has been particularly smart. They've been disciplined about capacity growth, focused on premium cabin expansion, and their international route network, especially to Europe, has shown strong recovery trends. When investors see a nearly 7% weekly gain on a stock that's already trading at $63.44, that's not speculative money. That's institutional confidence in their execution capability.
What about their balance sheet position compared to peers? Because we're seeing such divergent performance across the airline sector.
That's where Delta really shines, Sarah. Their debt management through the pandemic recovery period has been exemplary. While carriers like American Airlines are still dealing with elevated leverage, Americans trading at just $10.43, Delta maintained financial flexibility. Their ability to self-fund growth initiatives and return cash to shareholders puts them in a different category entirely.
And operationally, Mike, what are you seeing in terms of their competitive positioning?
Delta's operational metrics consistently outperforms peers in completion factor, on-time performance, and customer satisfaction scores. This week's gain likely reflects recognition that these operational advantages translate directly to revenue premium and cost efficiency. When you can charge higher fares and maintain better asset utilization, you're going to generate superior returns on invested capital.
The timing of this move is interesting too, coming as we head into the typically strong spring and summer travel season. Are investors positioning for earnings momentum?
I think that's exactly right. Delta typically provides strong guidance visibility, and their route network is well positioned for both domestic leisure recovery and continued strength in business travel. The 6.86% move suggests investors believe Delta will not just meet, but potentially exceed expectations for the upcoming peak season.
Now let's shift to those SEC filings we mentioned earlier. We had quite a bit of activity this week with 10 total filings across our coverage universe. Mike, what stands out to you?
Sarah, the filing pattern this week was particularly interesting. We had a cluster of 8K filings on March 17th from JetBlue, American Airlines, Delta, and Frontier, all on the same day. That's unusual and typically indicates either industry-wide developments or coordinated disclosure around material events.
Right, and we also saw Allegiant file two 8K forms, one on March 16th and another on March 17th. When you see multiple filings from the same company in quick succession, that often signals evolving situations that require ongoing disclosure updates.
Exactly. Now, we also had some routine filings. Southwest filed a Form 4, which is typically insider trading activity. Sun Country had an 8K on March 16th, and General Dynamics filed a Form 4 on March 19th. These are more administrative, but the concentration of airline 8K filings on March 17th is noteworthy.
The most substantial filing was probably FedEx's 10Q on March 19th. That gives us a real window into how the cargo and logistics side of aviation is performing. What's your read on the broader implications?
FedEx's quarterly filing is always important because they're essentially a bellwether for global trade flows and logistics demand. Their stock gained 1% this week to $358.85, which suggests the market received their quarterly results favorably. In the current environment, any sign of stability in cargo demand is positive for the broader aviation ecosystem.
This week's filings reinforced prior themes rather than introducing new structural shifts. But the timing and concentration suggest companies are staying proactive with their disclosure obligations as we head into what could be a pivotal period for the industry.
That's a great point, Sarah. The fact that we're not seeing dramatic tone shifts in management commentary suggests companies are executing to their stated strategies. For investors, Consistency in messaging and execution is actually quite valuable in this environment where there's so much uncertainty about broader economic conditions.
Now, let's turn to the news flow this week. We had several Boeing related headlines that certainly contributed to that 7.42% decline we saw in Boeing shares. Mike, walk us through what caught your attention.
Sarah, Boeing was definitely in the spotlight this week, but interestingly, not all the news was negative. The FAA cleared the Boeing 777-9 to begin the first part of TIA Phase 4 certification trials. That's actually a positive development for Boeing's wide-body program, which has been facing significant delays.
Right, but then we had some more concerning headlines. Boeing announced that first quarter deliveries will be lower than forecast, though they indicated they expect to catch up later in the year. That's the kind of execution uncertainty that makes investors nervous.
Absolutely. And delivery timing is critical for Boeing's cash flow generation. When you're already dealing with elevated scrutiny on production processes and quality control, any additional delays just compound investor concerns about execution risk. The stock's 7.42% decline to $195.12 really reflects that skepticism.
We also saw a headline about geopolitical risks, specifically how Iran war tensions could threaten Boeing beyond just airliner orders. Can you elaborate on that broader risk profile?
That's an important dimension that doesn't always get sufficient attention, Sarah. Boeing's defense business, supply chain relationships, and international market access can all be affected by geopolitical tensions. It's not just about direct orders from affected regions. It's about supply chain disruptions, regulatory complications, and the broader impact on global aviation demand patterns.
There was also an interesting piece about change incorporation and configuration control, highlighting the high cost of getting these processes wrong. That seems particularly relevant given Boeing's recent operational challenges.
That's absolutely critical, especially in aerospace manufacturing, where configuration management can literally be a matter of safety and certification. Any breakdown in these processes can cascade into massive costs, regulatory issues, and delivery delays. For Boeing investors, this kind of operational discipline is exactly what they're looking for evidence of improvement on.
Looking at Boeing's broader situation, Mike, how do you assess their current position? The stock is trading at $195.12 after this week's decline.
Sarah, Boeing remains in a challenging transition period. On one hand, you have positive developments like the Boeing 777-9 certification progress, which shows they are moving forward on key programs. On the other hand, the delivery guidance reduction and ongoing operational scrutiny suggest they're still working through fundamental execution challenges.
And from a valuation perspective, at $195.12, is the market adequately pricing these risks?
That's the key question. Boeing stock has been volatile, but at current levels, you're essentially betting on their ability to stabilize production, meet certification requirements, and restore operational credibility. The 7.42% decline this week suggests investors aren't quite ready to give them the benefit of the doubt on execution, particularly on delivery timelines.
The geopolitical dimension adds another layer of complexity that's harder to quantify but could have material impacts on their business model.
Exactly. And that's where Boeing differs from pure play airlines or lessors. They have this multi-dimensional risk profile that includes manufacturing execution, regulatory compliance, supply chain management, and geopolitical exposure. It's a complex investment thesis in the current environment.
Now, as we look ahead to next week, Mike, what should investors be watching for? Are there any key indicators or potential catalysts that could drive sector performance?
Sarah, I think the most important thing to watch will be any follow-up disclosure from those March 17th 8K filings we discussed. When multiple airlines file on the same day, there's often additional information or developments that emerge in subsequent days or weeks.
Good point. We should also be monitoring Boeing's progress on addressing those delivery timeline issues they highlighted this week. Any concrete steps to improve production efficiency or resolve regulatory concerns could help stabilize investor sentiment.
Absolutely. And with earnings season approaching in the coming weeks, investors will be looking for confirmation of the operational trends we're seeing reflected in stock performance. Delta's strong week suggests expectations are rising for their upcoming results.
What about broader industry indicators? Fuel costs, travel demand patterns, any macro factors that could influence sector performance?
Travel demand data will be crucial, especially as we head into the spring travel season. Any signs of softening demand or pricing pressure could disproportionately impact the ultra-low-cost carriers we saw struggling this week. Conversely, continued strength in premium travel would benefit the legacy carriers.
The cargo side will be interesting to monitor too, especially following FedEx's quarterly filing. Their performance often provides early signals about global economic activity and trade flows.
Right, and don't forget about fuel price movements and any supply chain developments. These can have immediate impacts on airline operating costs and consequently stock performance.
This week suggests investors are prioritizing operational reliability and financial strength over growth at any cost strategies, signaling that the current aviation cycle rewards proven execution capabilities above speculative positioning.
That's exactly right, Sarah. The market is clearly differentiating between companies with strong operational track records and those facing structural or execution challenges.
Before we wrap up, let's remind our listeners that all information discussed on Aviation Intelligence Weekly is for informational purposes only and should not be considered investment advice. Please consult with qualified financial professionals before making investment decisions.
And remember, past performance doesn't guarantee future results. The aviation sector can be particularly volatile, and individual stock performance can be influenced by many factors beyond what we've discussed today.
Thanks for joining us for another episode of Aviation Intelligence Weekly. I'm Sarah.
And I'm Mike. We'll be back next week with another deep dive into aviation market intelligence.
Until then, keep watching the skies and the markets.
See you next week.